How's it going out there? It's Tuesday, May 3rd. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down the headlines and tell you what's really moving these markets. What an insane market. Now, let me break it down for you. So let's go back to last Monday. Stocks fell 1.7%, pretty big move, before rallying late for a nice gain, which is weird. Then on Tuesday, the S&P 500 plunged 2.8% after some of the big tech names, FANG names, missed earnings. On Wednesday, though, everything was okay. We were cool. The S&P surged 1.6%. We were good. We were awesome until the afternoon when stocks gave up nearly all of its gains. The S&P 500 closed just up 0.2%. On Thursday, again, great stuff. The S&P 500 rallies 2.5%. We're out of the woods. Everything's all right. Then on Friday, what happens? The S&P 500 absolutely tanks. 3.6%. The NASDAQ fell over 4% in one day. A significant move. Let's go to this week. On Monday, we saw the S&P 500, and this is following that massive, huge loss on Friday. Fell 1.7%. Panic. Then the last hour of trading, rallying tremendously. Massive buying comes in. The S&P 500 goes up 0.6%. Guys, I've been doing this for a long time. These are absolutely insane moves. They happen during black swan events. But you look at the credit crisis, look at COVID. We have market conditions. We're seeing a lot of risk in the marketplace. But this is getting insane. As an investor, I mean, for me, I focus on individuals. That's why you listen to this podcast, right? Forget institutions. For individual investor, how are you not concerned with this? Even if you're a long-term investor, so the markets have gotten crushed, absolutely crushed over the past few months. You may be wondering why, how do I gauge this? When do I know to come back in? If I stopped out of a few names, is there more pain? Should I get out of the market, right? You want to try to figure this out. We all do. Even professionals want to. But you're wondering why we're seeing the massive moves. Why are we seeing the uncertainty? Why was back and forth, where there's no direction. And at the end of the month, there's a direction. We just finished lower. But right when we seem like, hey, things are okay. We're oversold. This is cool. It just turns out to be temporary. But you might be wondering, why? Why is it so volatile? Why? I mean, thinking, well, the 10-year hit 3%. 3%. Well, I don't know. I mean, we hit these levels when? In 2018, 2014, and steadily above 3% prior to 2011. We've been here before. You look at mortgage rates. Wow, surge over 5%, 5.5%, the highest since 2010. Great headline. But we've had high mortgage rates for a long period of time. Pre-credit crisis. People are blaming the war in Ukraine. New lockdowns in China due to COVID. Inflation out of control. The Fed tightening and reducing its balance sheet. While the major indices are below the 200-day moving average, which has never happened in history. But you know what? Even that's not the big story when you think about it. Because what we've done in the markets, at least since the credit crisis, we've always prepared for tough conditions. And when we see those tough conditions, we create a plan. We figure out how we can get through these messes and invest accordingly. And the Fed used to do a great job at that. An awesome job. Just say what they were going to do in the future so the markets could prepare. And that's a big change of pace. We didn't really see that. Volcker, Greenspan. But since credit crisis, we saw it. The Fed's very open. The governors all speak now. They all talk, right? We never saw that before, like 10, 12 years before. Now they all talk, every one of them. Different events. It gets picked up all over the news services and financial media. But they do this so we don't have any surprises, which is big. However, today, the reason we're seeing insane volatility, where we can't gauge the direction of the market, we have no clue where the market's heading, it's the massive uncertainty surrounding these events. And uncertainty is absolutely horrible for equities. And we see this all the time. I mean, IBM transitioning for how many years into cloud data analytics? It took such a long time, but the uncertainty there, right? And IBM did nothing. Its stock did nothing, kept going lower and lower and lower. So finally, it found a base, went higher, and said, okay, they finally made that transition. Yes, it took like 8 to 10 years or whatever. I mean, Ford's seeing their stock fall because it's evident they have no clue, absolutely no clue, when they'll be able to produce EVs at scale. They'll tell you the F-150 is ready, this is ready, no supply chain concerns. Remember, they told us that 12 months ago. They're easing. They're not. They're worse. That's why you see Ford and GM absolutely crash. We see when a company gets sued for a massive amount of money. The stock remains stagnant. Sometimes goes lower. But once they settle, they actually settle and say, even if they lose, when they settle that, the stock will pop because now there's certainty. Now you can predict. Now you can say, okay, here, we take this out. Here's the charge. Here's what they have to pay over the X amount of years. Now it's back to business, their core business, how much it's going to grow. And you could model for the company of where it's going to go. And the more you see clearly, the more you see that, the easier it is to predict. And that's what the markets love. What about we see uncertainty within a merger? Sometimes it's cool. A company merges with another. If you own the company that's getting bought, usually it's good. But what about the company doing the buying, the acquirer? Sometimes they have to go through regulatory Justice Department issues, especially if it's a big deal. So they'll be required to sell off current assets to make the deal go through. We saw this with AT&T, which I thought that deal was fantastic for them. I mean, they found a way with DirecTV, all this nonsense and these assets. They were able to put an extra $40 billion on their balance sheet, focus on the growth in 5G, and push streaming aside. It was a very good deal. The numbers look great, but it took what? A year? Well over a year to get this deal done? And what happened to AT&T? It significantly underperformed the market over that time frame. Well, everything else, and this is post-COVID, right after it started going a lot higher. But it was the uncertainty. The uncertainty is the death of stocks. We hate uncertainty. We hate it. And today, it's the most uncertain environment that I've seen in close to my 30-year career. We even saw Paul Tudor Jones on TV and CNBC. Said he can't think of a worse environment for stocks and bonds right now, while he reiterated how bullish he is on crypto. But here's a guy who's been doing close to 50 years. Because it's so difficult to predict the direction right now. We don't know what's going on. It's based on uncertainty. For example, the 10-year hit 3% yesterday. 3%. They made such a big deal. I thought they were going to put hats on, like they did with, every time the NASDAQ or the Dow hit like a certain level. I thought they were going to put hats on that it hit 3%. It was such a big deal. And you know who predicted that the 10-year was going 3%? Nobody predicted it. Goldman Sachs, and this is just February, a couple months ago, predicted the 10-year would jump to 2.25% in 2022. At the end of 2023, it would be at 2.45%. This was in February. This is how off they are. I'm just using Goldman Sachs' example. They were all off. Now Goldman Sachs predicting the 10-year to go to 2.9% in 2022. This was last month. We're already at 3%. It is saying 3.19% in 2023. And where do you think it's going to be? Probably a lot higher than that. It's already at 3%. Already met its forecast in 2022. And it could decline from here, and maybe they turn out to be right. But how wrong? I mean, that's a massive, massive miss. A massive miss. So this creates uncertainty. And the markets hate uncertainty. Look at the Fed. For close to 16 months, from July 2020 to November 2021, the Fed told us inflation will be transitory. It's going to go away. It's only temporary. The smartest guys in the room. It's going to come back to 2%. We might go a little bit above 2% for a little while, but it's going to come back down. 16 months. They said this. Inflation is 8.5% last month. That's the highest in 40 years. It's still not slowing. Now the Fed changed its mind, forced to aggressively raise rates, which, by the way, it still hasn't done. They're meeting this week. We're expecting a 50 basis point hike on top of the 25 basis point hike they just did. But aggressively raise rates, they just really begun. And then they're going to be forced to shrink their balance sheet, which, again, it still hasn't done. So when the Fed finally raised rates in March to 0.5%, right? They raised it 0.5%, right? To 0.5%. So they raised 25 basis points. It also increased its forecast, and this is in March, guys, for the number of expected rate hikes from just three rate hikes in 2022 to 7. This was 2 months ago. Let's calculate that, because at 7, if it's 25 basis point hikes, because that's what they're counting, right? It's not 7 hikes. Like, this isn't going to be 1 hike. This is like 2 hikes if they're going 50 basis point hike this week. That's going to bring the Fed funds rate from 0.5% to 2.25%. Yet the 10-year is telling us that we need to hike rates to at least 3%. At 3%, that's 10 hikes. What are you going to say tomorrow? Again, we got this uncertainty. And that's why everyone's looking forward to what Powell has to say the next few days. In fact, I've been doing this for a long time. I have no clue what he's going to say. Is he going to try to be dovish again like he was last quarter, which pushed the markets higher temporarily? You could say whatever you want. You could say, hey, you know what? We're not going to aggressively raise. You have to aggressively raise. Have to. But he tried to be dovish last call, which is impossible. Again, you need to aggressively raise rates here. We all know it. I mean, even he tried that approach. And it was funny to listen to the experts, the so-called experts on TV, say, I don't think he's going to be that he's going to be dovish. He's not going to be that hawkish, which is funny. Like he has a choice. But he tried that approach in March. And what happened? Like the next few days, almost every Fed governor came out and said, you're crazy. And then what did he do? He did it about face on Monday after raising rates Wednesday, a few days later, saying, no, you know what? We're going to have to aggressively raise rates. He changed his mind in 4 days. Uncertainty. How does the Fed plan on shrinking its $9 trillion balance sheet? Well, Powell came out and said, you know what? We're going to sell $100 billion of bonds every month. But let's do the math on that. Because that's going to bring us to $7.8 trillion in 12 months. Which doesn't even make a dent. So you're going to update that forecast this week? I don't know. Nobody knows. And for the past 12 years, again, since the credit crisis, the Fed is always telling us what they are going to do. Here's what we're going to do. Here's what to expect. This way you don't have these big market moves and nobody's surprised and holy cow. That's why you never see the Fed come out of nowhere and just raise much more than expected. Maybe they do that tomorrow and raise 75 basis points, which they should. They should raise by a point. Get it out of the way. Let the markets fall. But you'll provide certainty because you're getting closer to the point that you have to be instead of trying to sugarcoat it because you were so fucking wrong for the past 16 months. It's like a Band-Aid. Do you want to take it off really slow and be in pain? Oh, rip it off. Rip it off. We all know where it has to be. We all know. Even Powell knows. And you're using the word hope? That's uncertainty. How about war? When will it end? Russia stopped gas supply to Europe, which will send prices surging again. And high energy prices filters in to every economy across the planet, every single person, every consumer. But do we know when this war will end? We didn't think it would last this long. I thought Russia was just going to go in there, kick ass, and say, okay, everything's cool. And whatever the consequences of that or whatever they're going to do after that or who they're going to take, whatever. We thought that this war would end by now. It's not even close. More uncertainty. How about recession talk? Are we heading to recession? Powell says, no, you don't got to worry yet. No way. And what did we see yesterday? Roger Ferguson, former vice chairman at the Fed, said yesterday that a recession is inevitable. Totally contradicting Powell. Not to mention how many Fed governors said the same. And he was saying, Powell, he must raise rates quicker or the Fed's going to lose credibility. You lost credibility already. Holy shit. More uncertainty. What are you going to do? Are we heading to recession? Are we not? We're hearing from the same Fed, with people within the Fed saying it's guaranteed, but yet the leader of the Fed is saying, no, you don't have to worry about it yet. China's still on lockdown. When will that ease? Plus, China's pledging to stimulate its economy, which is the growth engine of the world. Hey, we're going to stimulate. We're going to stimulate our economy. We're going to become stronger than every country in the world. We're going to do lower taxes, a massive increase in infrastructure spend. That was easy to do because they were seeing inflation moderate a little bit. But the latest inflation numbers over the past 2 months were much higher than expected, than estimates. So are you going to do what we did? Inflation going higher? And you're stimulating the economy? Because look at where we are right now. And we're dependent on China for that growth. And that stimulus. How's it going to happen? How are they going to manage that? And recent lockdowns, they're creating another wave of supply chain issues. Again, more uncertainty. Looking at earnings. You want to see those supply chain issues? Look at earnings. Almost every single company this earnings season, it's about 65% that reported, almost every single company, is warning of supply chain issues. But how do you pick which ones can handle it and which ones can't? Because that's the question. Because GE got wrecked on supply chain issues. Ford's getting wrecked on supply chain issues. Rockwell Automation got wrecked, fell sharply in supply chain issues. That impacted earnings. You have 3M as well, right, in manufacturing, so 3MG. But then you're looking at Honeywell, and Honeywell reported great numbers. On Semi was able to pass on these costs to their consumers. They reported record earnings, record sales, record margins. Apple wanted supply issues, but again, they were able to meet their numbers and guidance. So these are companies that got it right. But it's not that easy to see who gets it right and who gets it wrong. I mean, take the companies in manufacturing alone and in semis, right? Where supply chain issues, they all have them. But how do we really pick which one is going to be impacted the most? Because if you look at Honeywell, you can say, well, they're a winner right now. Honeywell reported weak earnings and lowered their guidance last quarter due to supply chain issues. Then we had GM and 3M, or GE and 3M just report. So these companies just reported and they bombed their quarters. So you're sitting there at Honeywell. If you're a shareholder of Honeywell, you're selling your stock. You're like, holy shit, they won last time. Now their two competitors both warned and seeing significant supply chain concerns. A lot of these guys sell the same stuff. And now you're like, okay, I got to get the hell out of Honeywell. And what does Honeywell do? They blow out the numbers. They blow out the numbers. How do you predict that? How do you predict that in anything? I mean, other than flipping a coin, how do you predict that? How do you predict Honeywell blowing out the estimates under those conditions? You won last time. Your competitors bombed their quarters just ahead of you, and then you report blowout earnings and raise guidance? I mean, what the... You could see why we're seeing these massive moves when nobody knows where it's going. It's basically a guessing game. Like, hey, if I pick the right company during earnings season, it's going to go up 5% after earnings, and you're going to be like, yeah, all right. And then what happens? Then after that 5% gain, it slowly sells off. Expedia reported great earnings after the bells up 10, 12%. They'd opened today up 2%, 3%. UPS reported great earnings, and that stock just fell. So even the companies that are reporting great earnings, you're seeing sell-offs later on along with the market. Or the alternative is you pick the wrong company. Holy shit. Chegg down 40%. Netflix down 40%. You can lose 20% a day if they bomb the quarter. So how do you pick and choose? Because no one's immune to this. No one's kicking ass. This stock's all over the place. Down. Some of them are down 70%, 60%, 50%, and some are up maybe 10%, 15%. So Procter & Gamble or Clorox is down. Kroger is up. I mean, how do you pick? It's so difficult. We saw the same thing at the major tech companies, right? The FANG names always kind of went up in tandem. Yeah, some of them would take a break from others, but I mean, you look at the numbers now. Where Amazon, Netflix were terrible, Facebook was decent. I mean, it popped from oversold levels, but they weren't great numbers. It wasn't great guidance. They're going to report revenue decline year over year this year. So they weren't great. Google, Apple, Microsoft, amazing numbers. Even separation there among FANG names, which you haven't seen in 12 years before pretty much November. And most of these tech companies trade on the NASDAQ, including those semis that I mentioned. How difficult has this been? Here's the math. As of yesterday, 45% of stocks at the NASDAQ are down 50% plus. 22% of stocks are down 75% plus. And more than 5% of stocks in the NASDAQ are down more than 90%. That's the market we're in right now. And why we're in it is because nobody knows what the fuck is going on right now or how to predict it. It's almost impossible. That's why we're seeing these major swings just from Monday, how I started this podcast. I mean, up 1.5%, then finish the day down, then down 2.5%, then up 3% next day, then down 4% the next day. I mean, how do you invest in stuff like this? These are algorithms going crazy. But as an individual investor, how do you invest in this shit? It's hard. I feel you. We've stopped out of stocks. It's difficult. But now let's talk about inflation, how we're assuming that it's going to moderate. Inflation's moderating, which is good. It's not going higher anymore. We're seeing it. It's topping out. That's the big theme. That was a big theme a couple weeks ago, right? With core CPI coming in a little bit lower than expected. Well, you know what? Airfares. Airfares are up 39% year over year, and hotel rooms are up 52% year over year. That's as of this month. Gasoline prices still in their record highs. Everything is still surging in price. Everything. Yet economists and Powell see inflation easing. Why is that? Well, again, the thesis is based on last month's Consumer Price Index, CPI, which came in a little bit lower than expected, which, by the way, a little lower than expected. The CPI was up 8.5%, the highest inflation in 40 years, but it's moderating. It's what a joke. So the core came in lower than expected, and that's great. That's what we need to see. Finally breaking that trend of higher, just stop a little bit, come a little bit lower. That's fine. But let's go over what the CPI is. Okay, because the CPI measures this basket of prices. The core is the same thing, except it excludes what two components? Food and energy. Because they're really volatile. Food, energy. Let's take food and energy out there. This way it looks like we have no inflation, like we don't pay for food and energy. Okay, let's break down those markets really quick. I don't know if you saw the interview on CNBC with the CEO of BP. It was awesome. Breaking down the numbers. Telling us why oil prices are likely going a lot higher. And again, he could be talking his book, but if you're looking at the details and the statistics and the facts and the data, we have 1 million barrels of oil from Russia offline. More is coming as sanctions are really going to start kicking in on Russia. And what's Russia about to do? They're about to cut the supply of gas to Europe. What do you think that's going to do to prices? And we have a green agenda in our country where oil drilling is restricted. It's being restricted. Regardless of federal lands or what side, it's being restricted. They can't drill as fast as they want to drill and pull as much oil from the ground as they want, right? It's being restricted. Okay, so forget about the idea of producing more oil and filtering these profits into green energy and purchasing carbon credits, right? That's not good enough for our leftist politicians who would rather see more Americans homeless and tens of millions of others struggle paying higher prices at the pump. They'd rather see that. Then produce more oil, these companies generate more profits, and then you can put all that into green energy, right? This is a better solution according to them. But if you look at it, oil's not coming down anytime soon. And I thought it would be topping out. But when you look at the details, you look at Russia cutting the gas supply, you look at that war going on much longer than expected, and it's a huge bid under energy right now. And when you look at Russia, do you think that war is going to end anytime soon? I mean, the fighting's getting worse as it's going along. So in short, oil prices, are you expecting them to come down? No, but that's going to be excluded from the CPI. Now let's talk about food. Please pay attention to this segment because it will make you a lot of money. Because this is the other component of the CPI that's excluded from the core. Get ready to be blown away. So we have a massive shortage. It's such an overused word because I try to use a bigger word than that. Massive. I'll say 3 times shortage of fertilizer right now. Which is why I'm recommending Mosaic. We're up a lot on. Even though the stock's down 25% from its highs, it came down a little bit from its earnings report. But I'd be buying it, hand over fist right now. Buy any fertilizer company right now. And why am I saying that? Fertilizer companies use 3 key nutrients. It's nitrogen, phosphorus, and potassium. They also use ammonia-based nutrients since they can be mass-produced. This helps farmers increase their crop yields. What does that mean? The increased production of food while keeping their costs constant. They've been doing this over the past 50 years. But natural gas is a major input to produce all these chemicals. Where are natural gas prices? They've skyrocketed. Again, it's not going to change anytime soon unless the war in Russia suddenly ends and Russia and Europe are suddenly getting along, which we don't see. But all the other European nations are getting along. We don't see it. So it's not going to ease anytime soon. You would think that's the largest factor, energy prices. And you could say, well, it's cyclical and it'll come back down a bit. That's the least concern. That's the least problem you need to worry about when it comes to fertilizer. Because Europe and the U.S. have massive sanctions against Russia, which we know about. But they also have sanctions against Belarus, who's an ally to Russia. Now, Russia accounts for 20% of the world's nitrogen, phosphate, and potash exports. And since the start of the war, these exports have declined considerably, which makes sense. But Belarus is one of the large producers of potash along with Russia. So together, we're talking about 40% of the world's potash supply being disrupted. That's what's happening right now. But it gets even better because now we have to throw in China. So China, well, they're the largest phosphate provider in the world. And what is China doing right now? The country our politicians support the most to where we're not allowed to say anything negative against China or we're going to get thrown off social media. Not Twitter anymore, but all the other social media channels. So what's China doing? You guessed it. They're limiting the supply to the world. As the phosphate they produce, what are they doing with it? They're stockpiling it. which is brilliant. A brilliant move on their part. And forget energy, which China doesn't have any of other than coal, which they're mass producing, right? Our U.S. politicians don't care as if coal does not destroy the planet, right? Our coal doesn't destroy the planet. Only the coal that's produced in the U.S. does, right? So every place else, it's okay to produce coal. But in the U.S., it destroys our planet. We got to get rid of it. But everybody else can produce it. It's fine. It's not going to destroy the planet if they produce it, right? But China is actually brilliant because we're talking about food. And they're controlling the price of food right now, which higher prices can destroy developed economies, which in turn makes China incredibly powerful. It also creates a huge bargaining chip to get countries on your side when you go after Taiwan, which eventually they will. That's a bargaining chip Russia did not have before invading Ukraine. Could get any countries on its side. It's different now. Looking at China. Again, they're going to learn from that mistake. This is a big bargaining tool. So you have Russia, Belarus, China, the three of the world's largest fertilizer producers, all restricted production. That's why we're seeing fertilizer prices absolutely surge. Now, when you look at the farmers, it's not like they could pass off these costs to consumers. What do they do instead? They use less fertilizer because it costs so much. This, in turn, decreases their crop yields, which reduces the amount of food available for the world to eat. And now we have a shortage of food all over the world, which again is resulting in food prices skyrocketing. How much? Well, in February, the world food costs soared to an all-time high. All-time high, right? We're used to that with prices. All-time high in February. 1 month later in March, this is the latest reading. So April's going to come out next week. This is the latest reading in March. Prices rose another 13%. Not year over year. Month over month. They rose 13%. Wait till you see them come out this month. More importantly, wait till you see them come out over the next 6 months. Because if you're looking at prices and higher food prices, this sucks for us, right? Because higher food prices, we go out to eat, we all eat, right? We pay much higher prices in the future on food. That's bad. But think about third world countries. Because when we pay higher prices and we're pissed off, they're not going to have access to food. They can't afford it. You look at fertilizer prices actually tripled. And how bad is this problem right now, today, right now? We're not talking about the future. We're talking about right now. Peru's agricultural industry is facing a deficit of 180,000 metric tons of urea. It's a huge output in growing rice, potatoes, and corn. I know, probably means nothing to you, but they're predicting a 40% decline in supply due to higher fertilizer prices. A 40% decline in rice, potatoes, and corn. A 40% decline. The International Rice Research Institute, that's really an organization. They predicted crop yields could drop 10% next season, meaning there'll be 36 million fewer tons of rice. Let's put that in perspective. Enough to feed 500 million people. Sub-Saharan Africa is predicting a 30 million ton decrease in food production. That's enough to feed 100 million people. In Brazil, the world's biggest soybean producer, a 20% cut in potash could bring a 14% drop in yields. Costa Rica, coffee, representing 1,200 small coffee producers, sees output falling as much as 15% next year if the farmers miss even 1/3 of normal application, which they will. These are the problems we're facing right now when it comes to our food. Now, what about the future? Because that's where things get interesting, because they're telling us that inflation is going to moderate. It's going to moderate. We're going to be fine. It's going to slow. Here it is. So right now, farmers are significantly decreasing fertilizer usage for current crops, or crops that won't make their way to the shelves for months, right? It takes time to grow, then pick, then ship, right? We all know that. So the inflation numbers we're seeing right now are absolutely nothing, especially in the food category. I mean, we talked about energy, but the food category, it's absolutely nothing to where food prices will be over the next 3 to 6 months. Because farmers are using less fertilizer for these current crops that result in lower crop yields or much less food hitting the market. So fewer supply coupled with massive demand, economics 101, and prices for food, you think they're high now. Holy shit. That's why you should buy a fertilizer company. Buy any fertilizer company. Because prices of food, that's the next crisis. This is going to be one of the, if not the biggest food crisis we've seen in history of the world. That's how much prices are going to go higher. That's how crazy this is. China knows what they're doing. Russia knows what they know what they're doing. They're controlling the food supply. They know. Because higher prices are going to kill everybody. These are costs and even energy that are directly tied to the consumer. But yet, our wonderful government and Fed exclude this from their inflation figures. Like everything's going to get better because the core CPI came down. So we can see the core CPI come down. But inflation for these two components alone could go up 15% from here, which we're going to feel directly. So while the Fed's bullshitting you, saying, oh, well, it's moderating and everything's cool, you're going to be paying even higher prices for energy and much, much, much higher prices for food. I mean, think about that for a minute. Because the Fed is going to be talking out of its ass, the next couple of days, like it always does, because they should have been raising rates over a year ago to control inflation, where all asset prices surged to record highs. This was a year ago. Record highs. Earnings, home prices, household wealth, cars, almost every single asset surged all-time highs. And yet, continue to print trillions in money. Didn't matter. You, me, every American, every person on this planet that eats, drives a car, uses any type of energy to heat or cool their homes is going to see a massive increase in their cost of living as food and energy prices are not going to lower anytime soon. But again, this will be excluded. So if you're wondering why you're seeing these huge market swings, it's because of the uncertainty around these events where we can't plan. We can't say, okay, here's the top. Here's where we're going to hit. Here's rates going for the 10-year. 3.3%. Like nobody's predicting where we are. We're in uncharted territory right now. The predictions right now are so far out there. I mean, everybody's catching up, even the Wall Street firms. It's almost like all the Wall Street firms are predicting whatever. A company earns $1 a share and they come in at like 25 cents a share. And you're like, holy shit, how did that happen? Well, you're not updating your estimates. We're so far behind the curve to the point where even the analysts and the smartest people in the room really don't know what's going on because we don't know what the Fed's going to do, especially when it comes to inflation. We don't know about the war. We don't know what Russia's going to do. Are they really going to shut off the gas supply? I mean, it's going to hurt them, but holy shit, where the hell are gas prices going? Where do we see energy prices going? But that's why we're seeing these massive market swings, where we're not able to predict what's going to happen over the next 6 to 12 months. It's hard to find the catalyst, the positive catalyst. See, the war is going to end. Inflation is going to moderate. The Fed's going to raise by this. I mean, we don't even know how much the Fed plans on raising. They're saying one thing, and we know it has to be another, which is crazy. And what does that result in? These massive swings. And despite the massive volatility we're seeing on a daily basis, what happens to stocks? Going up and down. They're eventually ending up closing the month lower. That's what we did 5 of the past 6 months, including April, where the NASDAQ had its worst performing month since 2008, the credit crisis. But that's what we're seeing right now. I know. It's crazy. And it's negative. And I sell financial newsletters for our company. And I get it. It's probably not good news telling you this. Now, I'm going to give you both sides of the story. Because it is a little bit of good news. The market is down considerably. I just went over the NASDAQ numbers considerably in a very short time. In a very short time, considering there wasn't like this black swan event that took the market down 30% for it. This is just gradually like coming lower every month, coming lower, 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 lower as we deleverage and more money comes out of the system. But a lot of this is being factored in when you see in NASDAQ, some of these stocks down 40, 50%. A lot of it's being factored in. You look at earnings and sales are projected to grow just over 10% this year. That's pretty high, given the talks of recession and massive tightening, something we don't see. That's pretty strong earnings growth. Net profit margins are over 12%. They declined a little bit the last 2 months off of record highs, but 12% is still 1% more than a 5-year average. That's great for corporations. That's great for companies. That means their profits are still strong despite their stocks being down 30, 40%. That's positive. The 12-month forward PE, remember it being 23, 24? That was okay when interest rates are 0. Now they're expected to go a lot higher. The forward PE is just 18 right now. It's below the 5-year average. So we're getting to levels where we're seeing decent earnings growth and cheap stocks. We're not just seeing the cheap stocks in value. Remember, you can buy cheap stocks. They're going to go lower and lower. They get cheaper and cheaper and cheaper. You need some kind of growth catalyst. Otherwise, you're not going to go anywhere. Well, we're seeing growth in some of these markets. We're seeing some companies actually able to pass on these higher costs to consumers. Restaurants, semiconductors, manufacturing. There's winners and losers in all these industries. Even in the FANG names, winners and losers. It used to be all winners. Now you're seeing companies adjusting. So they're reporting strong earnings. Their stocks are cheaper because they've come down a lot. That's a pretty good sign. Okay, so it's not all negative. What we need is fucking certainty. We need the Fed to come out, raise by a point. The market's going to go down 4%, 5%, and then the next day it'll probably go up 3%. You know why? Because the Fed is closer to its goal. And as closer you get, that certainty is saying, okay, we're at the point where now we can start looking at stocks. We don't know. You're trying to play the game where you were so wrong. Just admit you're wrong. Admit you're wrong. Start from scratch. That's the playbook. I know it's not the playbook, especially in these in politics. Never admit you're fucking wrong ever. You're never wrong. Never go back on what you say ever, right? That's the playbook. Always say positive things. Never talk negative. That's the marketing playbook. Throw that out. If you want this market to go higher, be aggressive. Raise rates because that's going to provide more certainty that you're closer to the goal. When you were going to raise 25 basis points, now you're projected 50 basis points. It's going to be 50 basis points. Go 75. Go a point. Get it out of the way. We need some kind of certainty. We need inflation to actually moderate across the board. We need that. We need some certainty to get more investors back into this market. And that's one of the things you're seeing with something I track, which I show in a lot of my newsletters, is Bank of America, inflows, outflows, money's been pouring out. You're starting to see money push into the market at these levels in certain sectors, finally. And you look at earnings, pretty strong for 10 out of the 12 major sectors within the S&P 500. And a lot of these have margins that are growing. So there are positives there. We're down, but we need some kind of floor, something that we could say, okay, I see what's going to happen in 3 to 6 months. The Fed's going to stop raising rates. That's a positive. We don't know. Based on your projection of what you're saying you're going to do, it's going to take 18 months. That's too long. You're going to reduce the balance sheet? Just do it. Do it by more than $100 million. Much more than that, because it's not going to make a dent. Again, things that you're doing is not making a dent because you're hoping and praying that inflation comes down. I just showed you how when you're looking at oil and you're looking at food, inflation's not coming down anytime soon. It's not. So we need a playbook where we can provide certainty. When we have that, that's when you're going to have the confidence where people are going to come back in the market instead of picking and choosing like a Honeywell that won last quarter. Its two biggest competitors won this quarter, reported horrible earnings. So you aren't owning Honeywell saying, okay, maybe they'll get this right. Now you're selling it because you're like, wow, that competitor's it's terrible. And they come out and report great earnings. You don't know what the hell's going on. We don't know. You need certainty in this market. When you have that, that's going to be the opportunity to really get aggressively and pick away at a lot of these names that are down 40, 50, even 70%. Noel gets lots of questions off of this podcast. Feel free to email at frank@curzioresearch.com. That's frank@curzioresearch.com. That's it for me. Again, positive and negatives here. Always going to be truthful with you guys. I'm here for you. I know the market is difficult right now, but emails, I'm here. Questions, comments, frank@curzioresearch.com. And I'll see you guys tomorrow with Daniel. Take care.